Hi, everybody. Thank you so much for joining us today for this program preview for the Master of Science in Innovation and Venture Development. If this is your first time joining us for one of these sessions, the MSIVD is a brand new master's program that's starting this fall 2020 at Arizona State University through a transdisciplinary partnership between the Ira A. Fulton Schools of Engineering, the W.P. Carey School of Business, and the Herberger Institute for Design and the Arts. My name is Jackie Collins, and I am the graduate coordinator for the MSIVD program. I work with our students throughout the admissions process, and I also serve as an academic advisor to our students once admitted. So today, in just a moment, I will be introducing you to two people, Cheryl Heller and Laura Lindsey. They'll be having a conversation about finance and funding in the age of COVID-19 and how our MSIVD students can expect these topics to come up and be covered if they are joining us for the first cohort this fall 2020. So you'll be hearing from Cheryl Heller. She is the program director for the MSIVD and a professor of practice at ASU through a joint position between the three schools that are part of MSIVD, the W.P. Carey School of Business, Ira A. Fulton Schools of Engineering, and the Herberger Institute for Design and the Arts. And she's going to be joined today by Dr. Laura Lindsey. Laura Lindsey is an associate professor of finance with the W.P. Carey School of Business at ASU. Her research interests include entrepreneurial finance, venture capital and private equity, financial contracting, governance, and boundaries of the firm. She joined ASU in 2003, and we're very happy and fortunate to have her as part of our MSIVD faculty. With that being said, I am going to turn things over to Cheryl and Laura so that they can get started with our conversation today.
Thank you, Jackie, and welcome, Laura. We are, as Jackie said, thrilled that Laura is part of the MSIVD program as a founding faculty member. And just as we think that this program is an appropriate one for the times we're living in, the wisdom that Laura brings in terms of finance and what it means to entrepreneurs is exceedingly timely now. So Laura, why don't we start with a question about the difference between entrepreneurial finance as opposed to regular finance?
So in regular finance, we study kind of what should happen when capital markets are very well functioning and frictions are pretty small. So a firm would be able to communicate very well to outside investors that they had a good project and then be able to fund that project. Whereas in entrepreneurial finance, there's nothing but frictions. There's a lot of information asymmetry about the quality of the idea and the reputation of the founder. Uncertainties are heightened. The demand that an investor, the return that an investor might demand versus what an entrepreneur is willing to give up, the wedge between those might be very large. So that's a very large financial friction. And so in regular finance, in investment decisions or operating decisions of the firm are independent of how you fund the firm, whereas in entrepreneurial finance, they're very tightly linked. So one informs the other, and they have to go hand in hand. And so it really is a very specialized area in that regard.
Fantastic. And how does the role of finance integrate into the MSIVD program?
So we are going to be supplying the students with finance knowledge as they need it. So as they need to make decisions about the form the venture takes, they'll be getting the right finance information at the right time to develop the venture appropriately for, how it's going to ideally launch. If it's appropriate, we'll get them investor ready so that they can talk to investors or other financial stakeholders. And we'll do that in the summer. So instead of, maybe traditional case-based learning like I do in the MBA program, we'll just be using their own projects as the cases. So we'll help them develop financial forecasts and statements, be able to articulate the value proposition in a way an investor would want to hear it, and give them some basic finance for being able to do financial models to make scaling and growth choices, which is a whole complex area in and of itself, but we'll try to get the basics so that Founding teams at least know that by the time they leave. And then also, it's important that they understand deal structures and financial instruments and contracts that are used when early stage firms get financed. These are very specialized areas. And, you know, even someone who's well schooled in finance might not know all the bells and whistles that get attached to the financial securities in entrepreneurial finance. And so we'll make sure that the teams that need to know that will know what they need to know.
Fantastic. And as you know, we're interested in including social ventures and non-traditional ventures. What of what you're teaching applies to them, or how would it differ?
So it is a little different, right? So if you're not a highly scalable firm, you're not going to get professional venture capital. So nationally, 0.24% of firms are venture backed. So, you know, I talk about venture capital a lot, but that's largely because that's where I can see data. And so the same principles apply, they're just scaled down a little bit more. And so for something that's like a nonprofit or a dual purpose firm, it's still important to think about finance, even if your source of funding is a grant or a foundation. One form of sustainability is not to be begging for money all the time. So if you can show that that initial grant gets you over the hump and you can be sustainable, then, you know, this way of thinking is perfect. It's just that the financing path will be different, but the information will still apply. And even what they call entrepreneurship, so starting new ventures within an existing corporation, this is also very useful for internal ventures. So even though you're not going to necessarily be writing new contracts with your own corporation, you are going to be able to need to show financial viability. So anytime a corporation does something that's new, that's got some risk to it, right? And you're taking resources away from other projects. So you have to be able to communicate that the financial returns are commensurate with the risk that that firm is taking, or the founding team is taking.
Right. So is it safe to say that this isn't a good time to raise money?
So it's, we're all in this new boat, and it's not a great time for anything right now. The venture capital industry and financing industry in general is adapting just the way we all are. Instead of being in person, we're here on Zoom. And VC is doing the same thing. So deals are starting to get done. Even first rounds, so the initial meeting between an investor and a company. But it's still too soon to tell how, not to be pessimistic, but how bad it is, because it's these ventures, the deals that we're seeing get done, the people have probably met in real life before now. And so even though you're closing in this new separated distance world, a lot of the soft information and the getting to know you process happened before. And so it really is a courtship and marriage. So it's, while it's easy to maintain relationships from afar, it's harder to form them. So, time will tell. We're kind of 3 to 6 months in, and that's really what the time lag is. So it's really very early to know much of anything. So there is a bit of a dichotomy between what we see in early stage deals and later stage deals, where the investors would have already met the teams that they're funding. So there's some new research out that I could highlight if you want to see some pictures.
Absolutely.
Yeah. So this cartography project that Guzman and Stern started is fascinating. So what they are trying to do is to predict where high growth entrepreneurship starts. And so this is a new working paper where they looked at just what happened, what do we know so far in the age of COVID? And so because New York was so hard hit, I pulled the New York graph out of their paper. And what this graph is showing is new business registrations in 2020 versus 2019. And so there's no magic reason why we would expect 2020 to be exactly like 2019, but this gives us a sense of what perhaps should have happened and how big of a decline it is. And so there's some good news here too, though, which is that there's a bit of a recovery. So you can see, even though there's a decline in business starts, there's, we're almost back up to where we would have been in 2019. But the gap between those two lines is pretty significant. It's 11,000 firms in New York alone that, didn't get registered, that, presumably would have been registered without COVID. So that's a lot of firms. Other states that had declines where the data has been released already look similar. Manhattan looks similar. You have the sharp decline and then a recovery. But this masks some composition effects. So it not too surprising to learn that not many restaurants were some of the new business registrants in the recovery. But it might be a little bit surprising to learn that some of the new business names have COVID in the title. So COVID tax help, for example, and other sorts of things. So there are some really, what I'll call strange composition effects that we see, even though, the world is changing, right? So that recovery doesn't mean a return to what things were. It's just an increase in activity. And it's good that that was as rapid as it was. So that's encouraging, and from my view. So if we want to, so new business starts aren't necessarily the most innovative firms, right? This is going to be everything. And so if we want to think about more innovative firms, we can look at professional venture capital. So on the next paper is shows early stage VC deals versus late stage VC deals in the time of COVID. So with recent data from PitchBook. And so this paper is by Howell, Lerner, Nanda, and Townsend. And so what's interesting about this graph is you'll see that almost all of the decline that we've seen comes from VC deals coded as early stage. So that's great. That means that companies that have already started can find follow-on financing despite this disruption and economic downturn. Whereas early stage firms cannot. And even in the late stage deals, you can imagine composition effects where, travel startups suddenly have a harder time, whereas, things that enable doing business remotely will have an easier time. But the early stage deals decline is something we should really worry about, because the way venture capital works is you start out with lots of deals getting funded and then fewer and then fewer. And so it's the early stage deals where experimentation happens, and therefore where innovation happens. And so we've known that venture capital is very pro-cyclical, meaning you'd like it to be patient capital that smooths economic shocks, but it doesn't behave that way. It follows the public markets more or less, right, and the economic cycles overall. So this is, if you see the early stage being more subject to shocks, it means that innovation is going to be more subject to shocks. And that's exactly the point of this paper. And so if you look at the next graph, also from this same set of authors, what they've done is they've graphed important patents relative to other venture capital backed firm patents. So if you subtract those two, you'll get a measure of when important innovation happens. And so important for patents is measured by future citations. So this doesn't include COVID. This is through different recessionary periods in the US. So those red dotted lines are the NBER recession troughs. And it's hard to see from the graph, but you'll see little dips in the important innovation around the recession lines. And so what this means is that the financing appetite for risk is even more pro-cyclical than the normal funding activity itself. So there are a couple things going on. There's a composition effect of, hey, let's not fund new travel deals. But then there's also a pullback of, oh, there's a recession. Maybe I don't want to invest in new companies. Maybe I want to save some capital for my existing investments. And so you pull back a little bit to get the deals that you've already funded through to the next round. And so, that's just what happens. There's a general lowering of risk appetite. And so, that's what we're facing economically going forward. This is both a health shock and an economic shock. And so I would expect to see the same things post this little pullback, or large pullback rather, that we do in the financial crisis, for example. I have some work in progress of my own where I'm trying to look at how firms are affected when times of financing are tight. So in my own work, instead of doing early and late stage deals, I've coded things by whether they were first round or second round during the financial crisis. So if you could go to the next slide. So here, what you'll see is first rounds have quite a shock, and then what looks in the graph like a rapid recovery, but that's a 2-year time lag. So it's not as rapid as it perhaps looks. And the percentage decline in second rounds isn't as large, but it's still, it still matters. So on the one hand, this is encouraging because it means in the financial crisis, it was only a year or two to get back up to the early stage level of investment and, experimentation. But of course, we would prefer to smooth that period entirely, but you can't, right? These are economic shocks. Economic actors are going to do what's in their best interest. And so I would expect something like this to be what we face. And so if we're able to get a V-shaped recovery that's sustainable, we've seen the public market snap back. That's encouraging. At the same time, we shouldn't take too much solace from that, not to freak everyone out, but the same thing happened in 1929, and we know what happened the decade after that. So, no one knows what's going to happen. So, let's hope that it looks a lot like this, and that maybe there's a 6 months to a year of this disruption, and then we can get back to healthy levels of activity and experimentation. Even that second round graph masks a little bit about how hard it is to get your next round of funding. So if you look at the probability of a second round, for example, through the crisis, you can see, so this is the dates on this little graph are the date of your first round. So if we think of the financial crisis as hitting in around 2008, you see that if you got your first round in 2007, you already have a reduced probability of getting a second round because you needed capital in the downturn. So you ran out of money right in the middle of the downturn, and so your probability of surviving, or at least getting professional capital, is reduced all the way until 2013-ish. Right. And so that's when you would have gotten your first round. So, these time lags will be real and they will be significant. And, but that doesn't mean that there isn't economic activity happening right now. And it doesn't mean that in a year or two, we won't have first round fundings back. We just have to figure out how to do that going forward.
So I think that we are having some internet issues for Cheryl at the moment, but I just wanted to hop back in and kind of see if you could maybe kind of tie this back and talk about what this all means for students in the MSIVD program and what they should be thinking.
So, to say that something's unprecedented, we've heard that a lot, and it's now overused, but really, like, this is unprecedented because it's a shock that happened when the economy wasn't really, it was maybe we were stepping a little bit off the gas, but we weren't, this is not an economic shock that happened because the system was overheated in and of itself. And yet it can reverberate the exact same way that any sort of financial shock would have. And so on the one hand, students should take solace in the sense that they'll have a year to perfect their businesses. Also, think of the incumbents that may have been perceived as strong before, and I mean business incumbents here, not political ones. The businesses that may have been perceived as strong may be less entrenched now doing what they were doing, right? So you'll hear a lot of people say that COVID accelerated a lot of what was happening anyway. I don't necessarily agree with that wholeheartedly, because I do think there's going to be a demand for a little bit more of human connection. You know, I think there'll be a little bit of a flip back, but at least in the interim, you know, businesses are on their heels, right? So you see people adopting new technologies very quickly, and you see a need for innovation. So there's no shortage of problems to solve, and you know, there's certainly a need for innovation, and so there will be a lot of opportunity going forward, because the world is ready for disruption, as we have all the, you know, this new set of problems that have just been laid bare. They always existed, but now everyone knows their problems, which makes them a little bit more investable even.
That's great. Thank you. Thank you so much for taking the time to talk with us about this today. I think it's definitely a subject that is on everybody's minds right now. So I appreciate you joining us to share your thoughts. One thing I should have mentioned before we got started to all of our attendees, if you have any questions for Laura about anything that she's talked about today, please feel free to leave them in the Q&A portion of the Zoom webinar. We should have a few minutes at the end to answer any questions that you have. So if there is anything that you want her to elaborate on, or if you have any other questions, please leave them there. In the meantime, I am going to take a couple of minutes just to talk briefly about the MSIVD program specifically and our application requirements, as we are still accepting applications for fall 2020. So if you are considering applying, the things that you will need are your undergraduate transcripts. So you can either request your official transcripts from your undergraduate institution, or if you have access to unofficial transcripts, you can apply with those as well and submit them through the online application. If you are an international student and you would need to meet ASU's English proficiency requirement, there are a few different ways you can do that right now. If you have not taken an English proficiency test recently, ASU is currently accepting the Duolingo English test, and I believe that TOEFL also is offering an at-home version of the test currently as well. And then for the MSIVD application specifically, you'll need to provide us with an up-to-date copy of your resume and then a letter of intent. And the letter of intent is going to be your opportunity to introduce yourself to our program faculty. It should be, you know, more than 3 pages or so double spaced, and it's really just an opportunity, like I said, to introduce yourself, to talk about what has brought you to the MSIVD program, what it is that you are passionate and interested in, and what you would hope to get out of this program. If your application is selected to move on to the next stage in the evaluation process, once these materials have been reviewed, we would contact you with some additional questions and would ask you to schedule a brief online interview with some of our faculty. So we do have a deadline coming up tomorrow, actually, June 30th. So if you have not applied to the program already, I do strongly encourage you to apply by tomorrow. We do expect to continue accepting applications until fall on a space available basis. So if you are thinking about applying, like I said, I do strongly encourage you to apply by the deadline tomorrow, but there may be opportunities to apply thereafter as well. The link at the bottom of this page is to the MSIVD website, where you can find the link to start your application. And then I also wanted to just briefly give you some information about the program's tuition and fee structure. If you are curious about the program cost, the graphic on this screen will break down for you the estimated cost for this program based on your residency classification. It is a 1-year 30 credit hour program, so you would be taking courses in the fall, spring, and summer semesters. And as you can see, it is broken up into 12 credits in the fall, 12 in the spring, and then 6 credits in the summer. There is a program fee associated with the MSIVD program. It's $4,000 per semester across the board, regardless of your residency classification. And then your ASU tuition will be based upon your residency classification and the number of credits that you're enrolled in each semester. So we do have a few minutes left for some questions. Like I said, if you do have any questions for Laura, or if you have any questions for myself or Cheryl about the program more generally, please feel free to leave them in the Q&A section. While we wait to see if any come in, however, I actually did receive some questions yesterday from another one of our MSIVD faculty, Chad Kennedy, who works in the Ira A. Fulton School of Engineering. If you are new to this webinar series, Chad was actually one of our very first presenters a couple of months ago when we first started hosting these. So if you are interested in viewing his webinar, you can actually find a link to that on the MSIVD website. But Chad had a couple of questions for Laura. If you don't mind, I will pose a couple of those to you while we have a few minutes left.
Great.
So he asked, what is the guiding criteria that a startup should use to determine whether they should go to SBA, bank, or debt financing versus the investor route of money raising?
So it depends on the nature of the business. A bank or other debt financier is not going to invest in a brand new business without hard assets. And so the engineers and I joke that the way they define tangible assets is something you can drop on your foot or bump into. So, you know, yes, if you're going to be buying a truck or you need to do something to a building, then maybe debt financing can help in that regard. If it's you know, the HP folklore of starting a business where it's two guys in a garage writing software, you know, that's going to be an equity instrument, not a debt instrument, and it's going to be a pretty good, healthy chunk of equity, right? So most businesses, you know, I gave the 0.24% number earlier for professional VC. Most businesses are started by, you know, friends and family, founder debt, like your credit card debt or your home equity loans back in the day before the financial crisis. But, you know, your network of friends can write smaller checks, right? And if you have wealthy friends, then they can write bigger checks. But you know, most businesses are funded in that sort of bootstrap, scrappy way. And so, you know, collecting even equity investments from friends and family is something that that you would think about. But if you can get an SBA loan or seek debt financing in some way, that's often a cheaper form of financing than the equity route.
Right. And when is crowdfunding a good form of raising funds and when is it not?
So crowdfunding, and we should be specific, crowdfunding in the US is only recently including equity or, you know, financing type funding. Kickstarter and the like is really almost like a donation or a pre-order. So customers and suppliers are always great sources of financing. And so crowdfunding that isn't equity-based, but rather rewards-based is great for if something is consumer-facing. It's also great to have proof of concept before you go out and raise larger amounts of money. So oftentimes people will use Kickstarter as to create buzz to show that they can have sales before they even start, for example. And so that's a really good route for businesses that are consumer facing, I would say.
Great. And one more question. What is the most underestimated cost when startups try to project their costs of operations?
So not the serious answer first. I'm going to say all of them. A more serious answer would be, I can think of two. So the first would be that if you're successful, you're going to scale more quickly, and then you're going to have to hire more people, just speaking in very general terms. So your labor costs go through the roof way faster, and then you run out of money faster. And that's because of success. So you end up running out of money faster than you anticipated and having to raise more money, even though things are going really, really well. So that's something that people often don't fully internalize when they're just starting out and making financing plans. The other thing that I think entrepreneurs do is they underestimate what I'll call one-time charges that seem to pop up all the time. So when you close a professional financing deal, the first money that comes out of that goes to pay the legal fees to closing the financing deal. right? So, there are lawyer fees, there's, employee benefits, all of these sorts of things that you don't think about as product costs, labor costs, or, physical space costs, I think are hard to get a handle about what they're really going to look like. It used to be marketing costs, but now there's a lot of social media, so marketing can happen in a pretty cost-effective way, depending on the type of venture. So, the old joke is that you take an entrepreneur's forecast and you cut the revenues in half and you double the costs, right? And then you see, but I still want to invest if that's what the business looked like. So it's really hard to get a handle on costs. Just there's so much that's unpredictable.
Definitely. Well, thank you very much to Chad Kennedy for those questions, and thank you, Laura, for answering them. We are out of time for today, so I just wanted to thank everybody for joining us and remind you that we do have our next application deadline for the program coming up on June 30th, which is tomorrow, if you are watching this live. And again, thank you so much to Laura for being here. We are so grateful to have you as part of the program and to have you here to talk with us today.
My pleasure. Thank you.
Thank you. Everybody have a great day.